All right. Today is Sunday, April 3rd, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. It was supposed to be Friday, but now we're back to Sunday again. Things don't work out as you planned sometimes. But hey, the good news is we're here, so pop your Adderalls and let's get right into it. In focus tonight, a phony rebound, or is it? Because on face value, it appears that we have a legitimate rebound, a strong one, that will take us all the way back to all-time highs, baby. But when you dig down in the macro, things start to look a little fishy and perhaps scary. This could be one epic trap. Let's start with the facts here. This is the third week in a row where the S&P 500 managed to close in the green. And of course, it started about a couple of weeks ago, around March 15th, and it was a massive rebound higher. But look at this, the gains are receding, and we almost closed the week in the red on Friday, absent of the last-minute pump. So the question here is, looking at this, is the rally about to fade away? Are we about to resume the pain once again? We'll see. But here it is, a final hour surge Friday salvaged the third straight up week for the S&P 500, barely extending a run for U.S. equities that at time has ranked amongst the strongest in the past decade. The benchmark gauge has retracted well over half its tumble since the start of the year, a shock to institutional traders who spent most of the last 3 months slashing risk. A lot of people sold on the way down and then this quick surge. They missed out on it, said Craig Callahan, the chief executive officer at Icon Advisors. He also added, so I think they're trying to discredit it. Sort of saying, well, I did not get into it, it must not be real. So what he's saying is, sour grapes. You missed out on the rally, now you have to shit on it. This is at least what he's accusing the bears of doing. But the case of skepticism remains an easy one to make. Besides war in Europe, this week's jobs and inflation data reinforced the argument for a faster Fed tightening cycle. The bond market is flashing warnings over an economic recession, and the earnings reporting season due to start in 2 weeks is expected to show a drastic slowdown in corporate profits. Among investors surprised when the S&P 500 jumped more than 10% over 11 sessions through Tuesday were hedge funds. Those tracked by Goldman Sachs Group unwound the risky bets, cutting longs and covering shorts in 15 of the first 21 trading sessions of March. By Tuesday, the dollar amount of their de-risking was poised for the second largest monthly reduction in 5 years, behind only the Reddit-fueled short squeeze in January of 2021. The pattern was echoed at JP Morgan Chase, whose hedge funds clients also sold into the latest rally. We've just seen a very sharp rebound in equities that seems to have caught many by surprise, and which few seem willing to embrace as potentially persistent trend. And this is according to an analyst at JP Morgan. From a positioning flow perspective, it seems the pain trade is still higher for now, he added. Look at this. These are the hedge funds. The gross leverage and the net leverage are down. So the hedges are de-risking. They've taken advantage of this massive pump to de-risk and sell into strength. Getting louder on Wall Street is the drumbeat of warnings over a bear market trap. Strategists at firms from Bank of America to Morgan Stanley urged investors not to chase the gain, citing everything from an inversion in Treasury yield curves to stretched valuations and potentially disappointing earnings. At 20-time profits, the S&P 500 trades at a valuation multiple that before the 2020 pandemic had been seen only once in the past 2 decades during the dot-com era. Meanwhile, the cushion from corporate profits is thinning out. Profit growth is expected to slow to roughly 6% in the first quarter, down from an average pace of 54% last year, and this is according to Bloomberg. The Fed is tightening aggressively, profit margins will start to deteriorate, and that is the end of the cycle, said Mike Wilson, the chief equity strategist at Morgan Stanley. While we don't think there is a recession this year, the risk of a recession next year has gone up dramatically, Wilson added. Look at this. The S&P profit growth is actually deaccelerating, and it's about to go negative. That comes hand in hand with the haircut in PE multiples that the S&P 500 has been experiencing so far. So again, is it a good rebound when we look at the fundamentals? Not when you look at this. profit margins are about to go down. We're looking at peak earnings, folks. But what this rebound is all about is the remaining euphoria, the remaining mania in the stock market. They did not stampede to buy the best stocks. They certainly bought Apple and the ETF's leaders, Tesla and the likes. But they also bought garbage stocks, meme stocks, COS, AMC, GameStop. This is not a legitimate rebound when these are the leaders of the rebound. And bear in mind, we will talk in the heat map analysis, the abysmal performance of chips and transportations. Not a good sign. Anyways, recessions are threats that bull markets have not been able to survive historically. Increasingly, cash is the favored asset among the pros. In Bank of America's March survey of money managers, such holdings rose to the highest levels since April of 2020. Karen Pye, she probably eats a lot of pies in the face, right? Head of portfolio management and equity strategy at Fiduciary Trust International, which has around $103 billion in assets, is currently overweight cash. She and her team, amid the recent rally, raised cash by selling equities. We did not want to sell into the downdraft in January, but with this recovery recently, we did take some money out of equities, she said. So the smart money is dumping, the dumb money is buying, believing that this is a generational opportunity to buy the stock market. By the way, here's a little tinfoil hat segment / what's going on here. Remember the flush down on Thursday by the close when the stock market kind of took a massive dump by the end? Well, apparently there was a massive S&P 500 options trade that was behind that dump. What are we talking about here? Traders are pointing to a massive quarterly options trade on Thursday, they said, was from JP Morgan Fund as one reason why the stock market took a nosedive late in the day, as options flows linked to the trade exacerbated market weakness. I think that trade exacerbated volatility, said Brent Kombucha, founder of analytic services Spot Gamma, noting that this was out of the ordinary, since the quarterly hedging activity typically does not move markets much. The way the trade is structured means when the market starts to fall, options dealers, typically big financial institutions who facilitate trading but seek to remain market neutral, would have been forced to sell an increasing number of stock futures, thereby aggravating the sell-off, Kombucha says. The trade, which took place shortly before 11 a.m., was a large collar options trade involving the sale of about 44,000 June calls and the purchase of an identical number of June put spreads. So they're selling calls, 44,000 calls, and they bought puts instead. To finance the puts, they sold calls. The assumption is these are covered calls, and hence this is hedging activity. That would pay up if the S&P 500 were to decline more than 5% from its current level. A collar is an options hedging strategy involving a combination of puts and calls. The trade also involved the sale of about 24,800 calls linked to the 4,300 level in the S&P 500, set to expire at the end of Thursday's session, as a way to guard against any sharp moves in the market during the trading session. So they've already cashed in those calls. They sold cover calls with the expiration date of Thursday, and you know what happened. The stock market went down, so they already cashed in. This trade is already profitable, at least in one leg. So who was behind the trade, by the way? Here it is. Traders pointed to the $19 billion JP Morgan hedged equity fund as being behind the moves. The fund, which holds a basket of S&P 500 stocks along with options on the benchmark index and resets hedges once a quarter. Here comes the manipulators from JP Morgan, right? As the fund is so large, traders know and anticipate its patterns. Kombucha said that based on past trading patterns and details of investment strategies laid out in the fund's prospectus, the trade was initiated by the JP Morgan Hedged Equity Fund. Joe Tigay, portfolio manager at Equity Armor Investment, also said the trades had the hallmark of the JP Morgan's fund's hedging program. Why is JP Morgan hedging, by the way? That is an important question to ask. Asked about the trades, Kristen Chambers, a spokesperson for JP Morgan Asset Management, confirmed that the fund has scheduled quarterly hedging program but did not confirm the exact details of the trade. Systematic trades, often hedge funds, take a rules-based approach in their investment and are often driven by fixed quarterly schedules rather than strong investment themes. This is a systematic trade that we see at the end of every quarter, said Chris Murphy, the co-head of derivatives strategy at Susquehanna. Thursday's trade, worth about $20 billion. That is just systematic trade, right? No biggie. $20 billion in notional terms, based on the index level, replaces a similar position opened at the end of last quarter, and this is according to Trade Alert data. And by the way, the same JP Morgan says the S&P 500 will stall, then rise to new rally highs. And guess who said that, by the way? It is JP Morgan's Marco. Meanwhile, JP Morgan is using $20 billion in notional terms to hedge against the S&P 500. But here's what I want to do. Instead of just relying on these Wall Streeters, let's play a game. Because last week was a bonanza of macro data. Let's look at each data and play a game. And the game is this piece of data makes the Fed more dovish or more hawkish? And yes, we can visit more items from the wall of worry, like Russia, for example. There are rumors that we have peace talks, and soon enough we will see Putin and Zelensky meeting. Now, is this bullish or bearish for the stock market? Well, you have to look at it from the lens of the Fed. Does this make the Fed more dovish or more hawkish? The answer is they've been using the war as an excuse to be nimble and careful. Without the war, if we have a peace agreement, then inflation is going to accelerate again, and they're not going to have an excuse anymore. So believe it or not, in this case, peace is not good for market bulls because it will push the Fed to become less shy and start tightening aggressively now that the war is no longer in the picture. Likewise, if you look at China, for example, we're seeing macro data from China collapsing. A matter of fact, reaching below pre-pandemic highs and dipping back into the pandemic crash. Why? Because we have the thing cases continuing to move higher in China. But most importantly, China has the zero thing policy, and they have shutdowns all over the place. Shanghai is now totally shut down, and that is impacting these numbers negatively. So when we look at this, when we have a slowdown in China, for example, is this bullish or bearish for the stock market? Well, to answer that question, we have to look at it from the lens of the Fed. When we see a slowdown, economically speaking, and the cases of the thing are rising higher again, does this make the Fed more hawkish or perhaps more careful not to tighten aggressively right away? Well, I would argue that this piece of data, the fact that the thing is rising again, makes the Fed more dovish. So again, market bulls should be cheerleading COVID, COVID, COVID. Why? Because that is the only ally they got left. And it's an ally, to be frank with you, that is just going to delay the inevitable, because sooner or later, the thing is stagflationary in nature, and it's going to push the Fed to be more aggressive and more hawkish in the long run. In the short run, it keeps that gun in the holster when we talk about the Fed shooting the economy. But let's dig into the macro data that we got throughout the week. Most importantly, on Friday, the non-farm payrolls. We got 431 jobs created in March. The unemployment rate went down to 3.6%. The majority of these jobs, once again, were created in the leisure and hospitality sectors of the economy, meaning we're just recovering the jobs we lost during the thing crash. But there is another caveat in all of this, which is the fact that wage inflation continues to move higher. Matter of fact, this move in March was the biggest advance in wages since May 2020. But there is a caveat within the caveat, which is the fact that the majority of workers, before you celebrate that you're seeing wage gains of 5.6%, you got to remember this: inflation is running at around 8%. So all in all, the majority of American workers are getting a haircut when you factor in inflation. But if you look at the data all in all, 431 jobs created, the unemployment rate 3.6. Does this make the Fed more dovish or more hawkish? The answer is more hawkish, because this is the kind of cushion the Fed needs to start tightening. You add to that the stock market that rebounded higher and slashed half of the losses year to date. Now the Fed has a lot of cushion to start tightening aggressively. Another piece of data, the jolts that we got throughout the week. In this case, jobs openings, all-time highs. Yes, they're going down slightly, but we're still talking about over 11 million jobs open in this economy right now. This is full employment, and once again, the question is, does this make the Fed more dovish or more hawkish? The answer is more hawkish, because this is the kind of cushion that the Fed needs to start tightening, aggressively speaking. And by the way, people say, how could we go into a recession where we have this number of jobs openings? Well, you gotta remember this. Back in '07, '08, we also had the highest jobs openings at the time. And look at how fast we went from a booming economy with a lot of jobs, a lot of people affording homes, money all over the place. Yes, a little bit of inflation, prices at the pump moving higher. But look at how fast things started to crash in '07, '08, and we went from the hottest economy to the biggest economic disaster since the Great Depression. So if anything, when you see a hot economy that is too hot right now, you're getting closer to a peak. Inflation is just a byproduct of the excesses in the economy. And what happens is when you have a fragile recovery that is based on the Fed's cocaine operation, throwing money all over the place, when that money starts to dry out, and by the way, no more coke flowing into the economy as the Fed starts to tighten, the reality of this economy and this recovery starts to appear. That the so-called recovery was nothing mere of a facade. And once the Fed gets out of the way, the facade is gone. We see the reality of this economy that was fragile to begin with. Once the Fed starts to erode the demand in the economy, because we have excess demand right now, due to the excess liquidity. When the Fed starts to tackle that demand, you will see job losses so fast, your head is going to spin. All of these jobs with high wages in the leisure and hospitality businesses, these jobs will be lost as fast as we regain them. Because who's going to go travel? Who's going to go book vacations and cruises and travel on airplanes when the demand in the economy is being eroded by the Fed's tightening? So don't be seduced by the fact that we have a strong jobs economy. You have to ask the question, the most important one. Is this recovery in the jobs market fueled by organic drivers, or was it fueled by the Fed's cocaine, stimulating the demand artificially in the economy? What happens when that demand is gone? What happens when the stimulation is gone? Another piece of data, the Chicago PMI, year over year, it is down. But again, the reading is still positive. We're still in expansion mode, not contraction, at least for now, according to the Chicago PMI. Is this piece of data supportive of a more dovish or more hawkish Fed? The answer is a more hawkish Fed, because now they have the cushion still to start tightening. If these numbers were dropping down in a dramatic fashion really fast, then the Fed gets the message that the economy is driving into stagflation, and perhaps it is too late to start tightening the policy. But now they have the cushion to do so, and they must act immediately. We also heard news, as you might be aware right now, the prices at the pump are absolutely insane, specifically in a state like California. So people are going down to Mexico to fuel their tank, and they're driving back into California, to the point where the Mexican authorities suspended gasoline subsidies for the state that are bordering the United States. Soon enough, Mexico is going to build a wall. Not welcomed here, folks. Go back. And now the question is this supportive of a dovish or a hawkish Fed? When you have gasoline prices so high, people are so desperate they're going down to Mexico to fuel. That tells us that inflation is too hot, and the Fed must act hawkish. They must increase by 50 basis points minimum in the next meeting. Another piece of news. Good luck, by the way, finding a new car or even a used car. The prices are insane. We're talking about double the prices of a few years ago. We're not talking about 10 years ago. We're talking about a couple of years ago. You see certain models and you look at the price. Yes, the car is available, but are you that crazy to pay for it? Well, the answer is there is somebody who's crazy enough who's going to pay that price. And hence, there is support in this economy to keep this inflation afloat. A matter of fact, push it higher and higher and higher. Every time we get a dip in used cars or new cars prices, that dip is bought right away, and we see inflation moving back to all-time highs in new and used car sales. Why? Because there is something called aggregate demand in the economy. Prices go too high, and we see the consumer saying, that's too expensive, not interested. So the dealer lowers the price. And immediately, when the price goes down, we see a stampede, and they bid the price higher again. That is called aggregate demand. And the reason why we have such strong aggregate demand in the economy is the Fed's cocaine operation. All of those trillions, they're still floating around. They created a lot of jobs, excess number of jobs, and the companies were hiring first, asking questions later when they initiated these massive wages for new hires. And now we have a situation where we have too much money chasing fewer goods, because on top of the out-of-whack demand from the Fed's stimulation of the economy, which was not needed, by the way, on top of that, you have supply chain problems, the lockdowns and the shortages of ships, the shortages of other materials, and now we have a war causing more shortages. There is no way that inflation is going to cool down anytime soon because you still have too much money chasing fewer goods and you have too many winners in the economy. I hate to say that, but you cannot have everybody winning at the same time in the economy. Otherwise, you're going to have inflation, and inflation is going to sustain these high levels, and the reason is aggregate demand. The moment prices go down, demand will immediately snap back and push these prices higher again. Now, another macro data that we got on Friday, the manufacturing PMI. Look at this. This is alarming. Unlike the non-farm payrolls, unlike the ADP report, unlike the Chicago PMI, look at this. The manufacturing PMI is down 1.5 points in March. New orders down a stunning 7.9 points. Production is down 4 points. On the other hand, prices were up 11.5 points. What does that say? This is an indicator for stagflation, the pace of economic activity slowing down while prices continue to move higher with no stop in sight at all. This is not the piece of data that the Fed wants to see, because this piece of data says you're too late, Fed. You were too late when you insisted that inflation is transitory and you refused to tighten. And now you're too late to start the tightening, specifically in an aggressive manner, because the economy is already slowing down. The economy is already dipping into stagflation. You tighten aggressively now, you're going to have a guaranteed recession. The problem is, what is the alternative? Because you look at a piece of data like this, for example, inflation is moving higher in this country. And now we're at a point where the rise of inflation is impacting the demand in the economy because the consumer has to spend more on gasoline, grocery items. They don't have the disposable income to spend on services, for example. So we're seeing demand erosion in the economy already. But here's an important point. One would say, why would the Fed be too aggressive right now in tackling inflation when inflation is going to take care of itself? Meaning, inflation is going to go too high and the demand from consumer will slow down and hence inflation will cool. Well, maybe you haven't been paying attention to what I've been saying just moments ago. Aggregate demand. So long as people still keeping their jobs with the high wages, with the yayo all over the place from the Feds printing trillions and trillions of dollars, a lot of these trillions are still floating around in the system, waiting to land on something. Be it homes, be it cars, be it stocks, be it commodities. And speaking of that, by the way, stock market accounts still closer to all-time highs. You have too many winners in this economy. You have a lot of money still chasing these goods. And yes, prices could go out of control and that demand would be cooled down. The problem is, the moment prices respond and they move down a little bit, you see the aggregate demand kicking in and inflation moving higher again. For example, let's look at the housing market. Prices out of control, be it to buy a home or to rent a home. Look at Phoenix, for example. Good luck finding a home, whether to buy or to rent in, because the price is out of control. We're talking double the prices of a couple of years ago. You got to be absolutely insane to rent a property in Phoenix right now, or to buy one for that matter. But the moment these prices move down, you're going to see the stampede right away because that money is still in the system. The out-of-whack demand is still in the system. And the only remedy for now, since supply is nowhere to be found, and it is pretty much impossible for the supply to meet this level of demand in a short amount of time, it's going to take years for that to happen. The only remedy for now is for the Fed to erode that demand in the economy. But what does that mean, by the way? It means job losses. That's what it really means. It means the Fed tightening the monetary policy, tightening financial conditions, which will reduce corporate spending. The CapEx is going to go down because if you're a corporation, you're looking around and saying, you know what? The Fed is eroding the demand in the economy. Do we need this amount of employees? Why are we paying all of these employees high wages? And when our stock starts to go down in a stock market crash, let's say, the case becomes clearer for all of these corporations to start to get rid of employees. And that creates the domino effect, where somebody loses their job. Now they have an insane amount that they owe on their credit cards. And oh, by the way, they took a mortgage or a rent lease that they cannot really afford, and now they have no income. And things start to snowball rapidly, and the economy starts to dip into a recession. I mean, look at how fast U.S. companies delayed financial plans due to the war. If we have any hit to the demand in the economy, you think they're not going to stop hiring immediately? And oh, by the way, they're not going to start getting rid of employees right away. And I keep saying, folks, don't assume that your job is in the bag right now. And you go ahead and you spend on credit cards and you go on vacations and you take a mortgage you cannot really afford. The question should be always, what happens if I lose my job? Did I pay all my credit card debt? Do I have a cushion for at least 9 months to live on, to pay rent, to pay mortgage, to pay my grocery bills, my car payments? Do I have that cushion or not? Because if you don't, things could get ugly fast. And this illusion that you're looking at right now, that the economy is so strong because we have a strong jobs market, that is an illusion. Because the moment the Fed pulls back on that support, you're going to start to see job losses fast, specifically in the leisure in hospitality businesses. When we look at the Fed's dot plots, for example, the median outlook for now is a funds rate of around 1.75%, which is about 6 to 7 rate hikes, assuming these rate hikes of 25 basis points. But here's the problem. When we look at banks' estimates, for example, the median is 2.5%, meaning closer to 10 hikes, not 6 or 7. When we talk about Citibank, for example, they're talking about 3% by the end of the year, and that means 25 basis points hikes. The problem is we don't have 12 meetings this year. What does that mean? Citibank is assuming we're going to see multiple 50 basis points hikes in this year, and the yield curve already inverted, signaling that a recession is on the horizon. And by the way, people say, oh, it usually takes a year, 2 years before we get to a recession. Here's the problem. Things are unusual this time around. Yes, in previous cycles, for example, it actually took years in certain instances since the Fed started tightening for the yield curve to invert, and then a few years after that for the recession to actually happen. Not this time around. It took only 16 days since the Fed started tightening for the yield curve to invert. So who's to say that we're not going to have a recession by the end of the year? You gotta be prepared. But rest assured, the IMF is on your side, because the IMF says it is too early to talk about the risk of a U.S. recession. You gotta wait for the recession to actually happen, and then we talk about the risk of a recession. And by the way, let's take a tour around the globe and see if things are different, because we have central banks across the globe jacking interest rates higher. The problem is it's not doing anything at all to tackle inflation. The reason is, I told you in this channel, by the way, repeatedly, it's all about the Fed. It's all about the central bank of the world. It doesn't matter what Brazil is going to do. It doesn't matter what Mexico is going to do. If the Fed continues to be behind the curve, inflation in these countries will also move higher. And the reason is the reserve currency of the world, the dollar. All of these commodities trade in US dollars. And the inflation in commodities is not going to cool down by the Mexican central bank or the Brazilian central bank hiking rates. It will take the Fed to do so before you see the impact globally. We got data from the European zone, for example, and inflation is increasing in an alarming rate, by the way. Look at this move, a vertical move higher. Inflation in the EU right now at 7.5%. And this is the cooked number, by the way. You look at all items, tobacco, food, alcohol, industrial goods, services, but mostly energy. And now you have the Russia-Ukraine war and the threats by Putin to cut gas supplies to Germany and other countries. The problem is only going to get worse. And by the way, in a healthy inflation phase, you want to see inflation being led by services. This is not the case. Inflation is being led by energy. And this is how you know this is not the good inflation. This is a bad inflation. If we saw services moving higher, then we know there's a healthy demand in the economy, and you have a lot of money, a lot of consumers spending on services, and we have an expansionary phase in the economy. This is not the case. This is an inflation being forced on the consumer to chase these prices higher, specifically in energy, which, by the way, has ripple impacts across all items that the consumer spends on. You're using trucks to transport goods or grocery items. The increase in energy cost to fuel this truck will be passed all the way down to the end consumer. And they say that households will fare a lot better in this inflation because they have excess savings from all of that printing and staying at home during the thing. Here's the problem. Look at UK savings ratio, for example. It is dropping like a rock. Sooner or later, we will go down below the pre-pandemic readings, which already happened in this country, by the way. So all of this myth about the strong consumer, they don't have credit card debt, their savings are through the roof, bullshit. This is not what the facts say. And what is fueling the spending in the UK, in the EU, and the US? How is the consumer remaining this strong, by the way? The answer is they're swiping those credit cards up and down, up and down, up and down. The month of February, for example, was the highest monthly amount of borrowing from credit card users since 1993. And the major question here is, what happens as interest rates continue to move higher? You're going to pay more in your credit card balance. What happens if you lose your job? Question every consumer, every household must ask right now before it's too late. When we look at inflation in Latin America, for example, be it Brazil, be it Mexico, Chile, Colombia, Peru, the numbers are staggering. Even I thought that inflation in Brazil is peaking and it's about to trend down. But look at that. The dip is being bought in inflation because of aggregate demand, because of the insane money printing, and because of the recklessness of the Fed pushing commodities prices higher. So even if you are in Brazil, and your central bank has been tightening for a long while now, you're not seeing the impact because the Federal Reserve and the ECB remain way behind the curve. Inflation continues to move higher globally. Now, you sprinkle a little war on top of that, and war is stagflationary in this case because you have two countries that happen to be commodities giants, Russia and Ukraine. So if the war continues to go on, it will push inflation higher, in this case in the United States, for example, by almost 1.5%, while pushing GDP down a point or so, and hence stagflation. The clock is ticking for the Fed to start acting now before it becomes too late to tighten as the economy heads into stagflation. And the problem is, even if the economy heads into stagflation, well, prices are not going to go down because unless we have severe job losses and erosion of the demand, all what we're going to see is an economy that is stagnating while inflation continues to hold on at a high level. And the Fed will have to increase interest rates either way to tackle that inflation. The problem is when you increase interest rates under stagflation, that risks a prolonged recession or even a depression. So now the Fed has to use whatever cushion left in the economy, be it the jobs market, be it the Chicago PMI, to start tightening now. And that leads us the beginning of this conversation. All of this macro outlook that is pushing the Fed to become more hawkish is not a good environment to buy the stock market. And that makes this rebound really, really dangerous because a lot of things have to go the right way for this rebound to sustain and moves us all the way back to all-time highs. And none of these things are happening right now. Matter of fact, the opposite is happening. Anyhow, folks, we're going to move on here and cover the market information for you. And we start with the closing of the indices on Friday. And here we go. On Friday, the Dow Industrial Average was up 139.92 points, or 0.40%. The Nasdaq was up 40.98 points, or a gain of 0.29%. The S&P 500 also in the green by 15.45 points, or a gain of 0.34%. It was a roller coaster ride on Friday because, for the most part, the indices were down until the last 30 minutes of the day when the plunge arrived and saved the day. The sector's performances on Friday led by real estate, number 1, capturing the gold medal. Now, number 2 for the silver, materials. Number 3 for the bronze, utilities. The laggards of the day on Friday were led by industrials, technology, and financials. Let's contrast this with the weekly performances. Leading the pack at number 1, capturing the gold medal, utilities. Number 2 for the silver, REITs. Number 3 for the bronze, defensives. And the laggards for the week were led by financials, industrials, and energy. Now, ask yourself a question, by the way. Is it bullish or bearish that the market was led by utilities, REITs, and defensives? The market is acting as if we're already heading into a recession, and it is pumping the defensive sectors of the stock market. What about the advance to decline ratios? NYSE 69% advancing versus 28% declining on Friday. The Nasdaq 56% advancing versus 39% declining. Commodities, some of them are trading right now, but this is the picture from Friday. Crude was down, not by a lot. The WTI was down almost 1%, while Brent was pretty much flat. Gasoline was flat. Heating oil rebounded higher and gained almost 3.5%. Natural gas was also higher, closing the day with gains of almost 1.5%. Softs, a mini rebound in lumber. Lumber is attempting to recapture 1,000 once again. We'll see if that happens this week or not. We also got more gains on Friday for the winner this week, OJ gaining a little over 3%. Likewise, coffee closing Friday with gains of almost 1%. I promised you I'm going to cover the chart of coffee, but we're running out of time in this program, so I'll do that on Monday's video. Yet we have declines for softs, led by cocoa, which lost almost 2% on Friday, yet we have modest declines for both sugar, and cotton. Metals, not a good picture here. Usually we have copper as the outlier. Not this time around. Palladium was the outlier, closing in the green by about 1% on Friday, while we got declines for gold, silver, platinum, copper, all down. Silver lost 1.5% on Friday, but I'm seeing a lot of bullish activities, specifically in the options market for gold. We'll see if that pushes gold higher this upcoming week or not. But on Friday, meats were pretty much flattish for both feeder cattle and lean hogs futures, while we got sizable declines of a little over 1% for live cattle futures. Grains, mixed picture. The gains were led by soybean oil, closing the day with almost 2% gains, followed by oats, canola, and rough rice, modest gains for rough rice, while we have pullbacks, big ones, for soybean meal, down over 4% on Friday alone. Likewise, we got declines of more than 2% for soybeans, corn, wheat. All of them were down more than 2% on Friday. Moving on to the options market, the big casino. On Friday, the hottest table by far was Apple at around 1.1 million contracts traded for the name. About 57% of those were calls. At number 2, Tesla, the souffle, with around 850,000 contracts traded on Friday. About 57% of those were calls. At number 3, AMD, with around 800,000 contracts. About 58% of those were calls. Look at AMC, it went down in volume on Friday. And when we look at the implied volatility for AMC, for example, last time we looked at this, it was around 90%, the IV percentage. Now it went down to 68%. What does that mean? This is an important lesson, by the way. You want to ride the ride higher as the implied volatility is also moving higher. And it doesn't really matter whether the stock is going up or down. The implied volatility increases as the stock is moving one way or the other. And as an options trader, you take that opportunity and you ride the wave higher, whether the stock is going down or up. The implied volatility moving higher in that particular direction. For example, if a stock is moving higher, like AMC did last week, and the implied volatility was 75%, and it moved to 80, 83%, you want to ride that move higher, hopefully, till the implied volatility reaches 90, 95, and that would be a signal to get out, because the inverse will start to happen. Likewise, if a stock is going down and the implied volatility is moving higher, you want to ride that move to the downside until the implied volatility tops, and then you know that the stock is about to bottom. This is exactly what happened to AMC. We got to 93, 95 in the IV percentage. That was a signal the stock is topping, specifically when the IV percentage started to move down, and it got all the way down to 68% by Friday's closing. Anyhow, here are the unusual activities that took place in the options market on Friday. We start with the ticker IWM, the Russell 2000. They're buying puts here, the 165 puts for the expiration date May 6, with the expectations that the IWM could drop down by more than 20.5% by then. They paid around 30 cents a piece to enter this trade, all in all spending around $1 million. What about the trade for the ticker AMD? An awful week for AMD, but somebody's betting for a rebound here, buying the 115 calls for the expiration date this upcoming Friday, April 8th, with the expectations that AMD could bounce higher by more than 6% by then. They paid around 85 cents a piece to enter this trade, all in all spending around $1 million. What about the ticker GDX? This is the gold miners ETF. And by the way, we've seen a lot of bullish activities for gold ETFs on Friday, not just the GDX, but also the GLD. In this case, they bought the 45 calls for the GDX, all for the expiration date April 29th, with the expectations that the GDX could move higher by more than 14% by then. They paid around 30 cents a piece to enter this trade, all in all spending around $300,000. What about the trade for the ticker DDOG, Datadog? Lots of call options buying for this name. We covered one trade last week for Thursday, but they're also buying more calls this time around. In this case, the 170 calls for the expiration date this upcoming Friday, April 8th, with the expectations the name could move higher by more than 11% by then. They paid around 75 cents a piece to enter this trade, all in all spending around $600,000. What about the ticker LUV, Southwest Airlines? They continue to buy names. They continue to buy calls on this name, in this case the $50 calls for the expiration date May 20th, with the expectations that Southwest Airlines could move higher by more than 9% by then. They paid around $1 a piece to enter this trade, trade, all in all spending around $800,000. What about the ticker SNOW Snowflake? I bought some calls last week, and I'm done with those calls. All I needed is just a little move in Snowflake, and it moved significantly higher, by the way, by the tune of over 8% throughout the week, and then it pulled back. So I'm done with the trade, but somebody still sees more gains to come for Snowflake by buying the 270 calls for the expiration date this upcoming Friday, April 8th, with expectations that Snowflake could move higher by more than 15% by then. They paid around 50 cents a piece to enter this trade, all in all spending around $400,000. What about the ticker KBH for KB Homes? An awful performance year to date, and the reason is the 10-year yield, interest rate, mortgage rates are moving higher. You don't want to be with these home builders right now. But is the trade for now the 10-year yield peaking? If that is the case, we will see a rebound in the home builders trade, in this case KBH. And somebody bought the 36 calls for the expiration date, May 20th, with expectations that the name could move higher by more than 10% by then. They paid around 75 cents a piece to enter this trade, all in all spending around $500,000. Moving on to the heat map analysis. This is the heat map on Friday. It's a sea of green with exceptions, really important exceptions. Look at transportations, railroads, UPS, FedEx, trucking, rental, all down big in industrials. Likewise, another cyclical sector of the stock market, chips, down big on Friday. How could you seriously believe in this rebound when the two most important leading indicators for both the economy and the stock market, transportation and chips, are down? This is an alarming signal, at least what we got on Friday. Yet even when we look at the weekly performance for the heat map, look at chips down big, transportation down big, even banks are down big. And even the inflationary names that led the gains year to date, we're talking about fertilizers, energy, those were down too. And what led the so-called rally for the third week? We're talking about defensives, REITs, utilities, the recessionary kind of sectors. You want to be in these sectors when we're anticipating an economic downturn. Likewise, some of the gains were led by options moves, be it in Tesla, be it in certain software names like Snowflake, Uber, Intuit, Snapchat. And that again raises the question, by the way, can you trust the rebound? These are the leaders? Sure, it started as a pump buying the big caps, Apple, Microsoft, Amazon, Tesla, but we're not seeing a follow-through, at least in last week's activities. What we saw is the remaining gambling activities using options in certain names, and then the pure defensives, be it consumer defensives, REITs, or utilities. This is not a good sign, folks. When we look at the heat map for the ETFs, a weekly perspective, the gains were led by the XBI Healthcare. This is a loser year to date, so we're seeing a lot of short covering and rebounds in the XBI, but the majority of the gains were led by REITs, for example, the IYR, utilities, the XLU, defensives, consumer staples, the XLP, but the cyclical sides of this economy, energy, chips, the SOXX, regional banks, KRE, were all down. When it came to growth versus value, still growth outperformed value. Growth was in the green slightly, while value was down also slightly. We will look at commodities, not a good performance this week. Gold is down, uranium is flat, and the winners are natural gas, UNG, and gold. Look at the GDX, for example, all closing in the green. International markets, all in the green, modestly, but the gains once again were led by the EWZ, which is my pick in this channel, the EWZ. I've been a proponent for the EWZ since the beginning of the year. Matter of fact, before the beginning of the year. And do yourself a favor, by the way, look at the year-to-date performance of the EWZ, exceeding over 30%. We have rout in US, European, and Asian equities. I don't know how long this outperformance will last, but for now, we're sticking with the EWZ. Let's move on and cover some charts, and we start with the SPY, the S&P 500 30 minutes chart. And I'm going to take it easy this time around because the last couple of videos, I've been talking about targets, and if the SPY goes down to this, then this will happen. If it goes up to that, then that will happen. And it's been confusing for a lot of viewers. So let's take it one step at a time. The most important behavior you want to watch for in any chart, but specifically now, is how they hold and trade around important support levels. For example, in this case, 451 is an important level. We know that because we've seen multiple reactions at around 451, 450. Did the chart close the day above or below 451? The answer is above. Yes, it was a rescue operation by the end of the day, but it doesn't take any credit from the move. The chart managed to close above 451. Do we have any signal whatsoever right now that we got a reversal last week, that the rally is over in the SPY? Not looking at this chart. It is still trading above 451. It is eyeing 454 once again. No significant damage happened to this chart whatsoever. If anything, it ran out of gas and it pulled back. We've seen some profit taking, and now the psychology becomes supreme versus the technicals. The holders versus those waiting on the sidelines. Which one is going to fold first? And you're going to see this theme, by the way, not just in the SPY's chart, but also in Apple, Tesla, and many other charts. Will the buyers who bought the dip and they're sitting on profits right now, will they fold and say, you know what? Things are not adding up here. Let's book these profits. It appears that this is a bear market trap. It appears that this is a bear market rally. Let's get whatever profits and move home. When will that thinking start? That is anybody's guess, but think about it from that perspective alone. Let's say if the chart goes down to 443, for example. Now you have a huge chunk of the dip buyers sitting on losses. You go down to 438, for example. Now we're getting the majority sitting on losses, and that kind of accelerates the move to the downside. On the other hand, of those waiting on the sidelines with the FOMO, waiting to buy the dip, but they think it went a little too high too fast, and they'll get it at a better price. Well, the chart went down from 461 almost to 451. It gave you $10 worth of discount. Is this attractive enough? Well, it will be if the SPY opens a Monday higher, recapturing 454, or even 459. Then those waiting on the sidelines, the FOMO starts to kick in, and they say, you know what, this is as good as it's going to get. Let's buy right now. And we see the SPY moving higher and making higher highs. The psychology is more important in this case. Here's a daily chart for the continuous contract for the S&P 500. Any damage done? Not really. The chart lost the support of around 4,549.5. That's about it. For all you know, the chart could rebound higher and recaptures that number by tomorrow, for example. So this could be a bear trap in the making. You're not going to be sure that this is not a bear trap until and unless we see losses of important support lines like 4,472, for example. But for now, it's a little too risky to assume that the bullish run higher, the rebound is over. Yes, the volume is moving higher again. Yes, the momentum indicators are topping, but so far these are not enough as indicators to start going all in, shorting the stock market and buying puts. The pies are still here, they're warm, and they're ready to be served. What about the SPX, the cash index for the SPY? It closed the week above the 200 days moving average. This is a massive win for the bulls. The problem is it lost 4,590, and I promise you it's going to be really hard to crack above that number again. What about the Qs? 30 minutes chart, similar story here. It appeared that the Qs is getting a little weaker because by the closing on Friday, it appeared that the Qs was about to lose 360 as support. Now, we're not going to be bearish on this chart until it loses 352 as support. Why? Because the chart told us that this is an important number to look out for. But losing 360 for the week could have been a symbolic win for the bears. But rest assured, the plunge, the pumpers, came out late in the day. They managed to close the Qs above 360. I say that is a win for the bulls. They're keeping 360. Yes, the chart went down from around 370 all the way to 360. That is about $10 worth of discount. And the battle now, just like we talked with SPY, who's going to fold first? Is it going to be the holders, the dip buyers who are already in? Are they going to start booking profits? Or is the chart about to move its way higher, kicking that FOMO for those waiting on the sidelines, and we see higher highs for the Qs? For now, the support is 360, the resistance at 363. And here's a daily chart for the continuous contract for the Qs. And again, for now, it is a pullback, folks. It is not a reversal. We haven't even reversed 2 days worth of candles. For now, you have to treat it as a pullback, even though the volume is moving higher, even though the momentum indicators are topping. All indicators that perhaps we're about to see the acceleration of losses. But do you bet on it right now? Too risky in my opinion, because the chart all in all only lost 15,000 as support. If it loses 14,445, then we're talking. If that happens, you will see a confirmation in the MACD crossing to negative territory, showing red impressions in the histogram. And we will get the confirmation that we have a reversal in hand, and at that time, there will be plenty of meat to chew in the bone. You don't have to rush it right now and get served a pie in the face. Here's a 30-minute chart for the IWM, the Russell 2000. Again, we got to pull back. But was there any damage done to this chart? The answer is not really, because 204.5 is still intact. You lose that, and then we're talking. All what the chart's doing right now is giving those waiting on the sidelines a discount from 211 to, let's say, 205. But the pies, once again, are ready to be served both ways. You could buy the dip right now. You could have bought it on Friday. And what do you know? We see a pullback this upcoming week, and the IWM loses 204.5. So you need to see some sort of a cushion, and that cushion would be recapturing 208 as support. For the bears, you don't want to jump ahead of the move when 204.5 is still intact. Wait for the chart to break that number, and then you have the signal to start shorting. By the way, here's a weekly chart for the RUT, the Russell 2000. We have confusing messages here. On one hand, the chart have already broken an important line, 2100. It is now fighting back to retest that line as resistance and perhaps as support. You look at the momentum indicators. They've been in negative divergence. This is a weekly chart, by the way. They've been in negative divergence since almost a year ago. But the momentum indicators are bottoming for now, and they're curling the way higher. Is this a signal that the IWM is about to rally higher? This is at least what the technicals are saying. The problem is, when you use your head, you have to ask, on what basis would the IWM rally on? The reopening? How many times do you want to juice that one up? How would airlines, cruises, casinos, the reopening play, how would that be revitalized right now when we have a Fed that is about to tighten? This is the battle between the technicals and the fundamentals. And by the way, using the RSI and the MACD indicators, even if they cross, producing green impressions in the histogram, they bottom, so to speak, that doesn't mean that the IWM has to blast higher. The IWM, the Russell 2000 for that matter, for all we know, could just consolidate for a little while, or maybe build another trap for the bulls to think that it's all clear and it rallies all the way, let's say, to 2,264. And then we see the rugs being pulled again. And this dilemma, by the way, is stopping investors and options market traders from making long-term commitments. There is no conviction. You look at the options market activities, for example, there were 7 days here, 2 weeks there, maybe a month, all in all, but they're not betting for longer expiration dates because nobody can see with clarity and conviction what's going to happen here. The Dixie, the dollar index, what's going on here, not calling the Dixie dead until and unless 97 is broken as support. We have the negative divergences, and instead of playing out via flush down, they're playing out via consolidation. In my book, that is bullish for the dollar, not bearish. And sooner or later, we will see the psychological target of around 99.9, let's call it 100. I believe that the dollar bulls want to take a swipe at 100 before they give it up. And here's gold. What's going on with gold? Still consolidating, still hugging the Fibonacci support at around 1,950. Nothing is going on here, but folks, I'm seeing a lot of bullish activities in the options market for gold. And by the way, a better way to bet on gold is not buying futures, but buying gold miners. This is what I've been doing year to date. And let's go back to the call that I made back in December 22nd for one of the gold miners that I happen to own right now, New Mount Gold. Let's cover some gold miners. Starting with the ticker NEM for New Mount, we have 53 as support. This line has been tested over and over and over and over again. Ask yourself a question here. If the chart wanted to trade below that number, it had plenty of opportunity. Why would it break that support line right now? Does it make sense? If anything, it means that we have a solid support. We have a process of gathering of energy from this consolidation. That energy will be released to the upside. Again, I do not guarantee anything here, folks. Matter of fact, if you listen to me, you're probably going to lose money. So just do the opposite, and let's see how that works out, right? And here's the update. Since then, the stock gained over 50%. It is obvious, folks, that the gold miners outperformed the move in gold tremendously because the gold miners are holding the gains so far. They did not give it up even though gold futures went down. Now, all of these charts are getting a little overextended, technically speaking, because they've been the year-to-date winners, be it gold, be it fertilizers, be it oil, be it gas, and you have a lot of thinking out there that says, okay, take profits from these plays and let's buy the losers year-to-date. The RKKs of the world, the technology software. The problem is the argument is not convincing so far because the fundamentals and the tailwinds for gold, for oil, for gas, for fertilizers, the tailwinds are still intact. The headwinds for technology and RKK are also still intact, and they're getting stronger by the day as the Fed becomes more aggressive in their tightening policy. What about oil? Brent, we were anticipating a rebound from a double bottom at around 105.84. That did not happen. This is a 4-hour chart, by the way. But look at that number, 105.84. It is acting like a magnet for now. And we have a sloping line of resistance. The question is the chart of oil, in this case Brent, making a saucer bottoming formation? And is it about to cross above the sloping line of resistance? If that is the case, it will be a massive, massive smack in the face to the Biden administration. The release from the SPR was misguided. It did not do shit to drop oil prices down. And here's the 10-year yield, the daily chart. It is rebounding from 2.34. You want to call this a pullback? Sure. But again, the momentum indicators are so extended right now, it wouldn't be out of the ordinary for the 10-year yield to move further down. Let's say to 2.2, for example. But the resiliency is obvious, and for the obvious reasons. The Fed is tightening, they're raising interest rates. Every piece of data we get points out for higher inflation. So for now, I'm just playing the technicals, calling for a pullback in the 10-year yield and a rebound in the TLT. But that dynamic will shift again, and we will see the 10-year yield moving higher again at some point and the TLT moving down. But for now, here's a weekly chart for the TLT. Since I started buying calls, so far so good. The chart made it all the way not so close to the target at around 134.5, but perhaps it ran out of time. The momentum indicators got way oversold. They're curling their way higher. We're seeing more buying in the TLT. My goal is 134.5. If the trade gets me a little more than that, let's say 140, then so far so good. I'll take that, no problem. But I'm being cautious of being too optimistic here, or maybe too callous to call the 10-year yield to drop down to 2.2 or below 2%. Maybe that's not going to happen. Maybe that dip that we got last week is all what we're going to get in the 10-year yield. You got to be prepared for all scenarios. What about the VIX 4-hour chart? It attempted to close above 20 by the end of the day, but you know the pump happened and the VIX went down accordingly. So this is, on paper, a win for the bulls. The VIX closed the week below 20. But watch out here. As we get closer to earnings in about 2 weeks, the depth of earnings season, you're going to see a lot of hedging. The Johnny-come-latelys want to hedge. Why not hedge right now when the VIX is below 20, when puts are cheap? This is at least my strategy for now, because I believe that the VIX will snap back in an aggressive fashion. You don't see it right now, but when it happened, you'll start to say, oh, I wish I bought some hedges back when the VIX was below 20 and all these puts were cheap. This is the time to hedge. Here's the VXN 4-hour chart, the VIX for the NASDAQ. It got a rejection from 27.5, which is the equivalent of 20 for the VIX. This is again a good sign for NASDAQ bulls, that perhaps we will see a resumption of the gains and a resumption of the collapse of the VXN. The problem is, look at the MACD indicator. It is starting to show green impressions once again. So could this be a trap for NASDAQ bulls? We'll see. But I would say at this point, after a massive drop in a short amount of time, from let's say 37.5 all the way down to 27.5 in the VXN, it is not out of the ordinary for the VXN to snap back in a sharp upside rally. In certain cases, believe it or not, greed is not good. You got a nice bump in the NASDAQ and a nice collapse in the VXN. It's time to lighten up. And here's a daily chart for Apple. A nice rebound at around 172.41. All of this is bullish activity for Apple, but we talked about the running out of gas. And this is exactly what we're seeing right now. Will it be a pullback? Did we get the pullback already? 172.4, is that as good as it's going to get? It appears so for now, but watch out for the momentum indicators. They're topping. You're seeing the MACD indicator, for example, these green columns getting shorter and shorter and shorter, meaning the move higher for now has topped and expecting it to move higher again and make higher highs is the weaker odd. The better odd says maybe consolidation for now at around 172.4 and then a move higher again, or we haven't seen the end of the pullback and Friday's candle could be a trap. We'll know that right away once the chart loses 172.4 as support. What about Tesla, the Stagflation hourly chart? This is actually a 2-hour chart, by the way. It is a battle of psychology, just like we talked with the SPY, between the holders and those waiting on the sidelines. So far, the holders are not budging. They're saying, you know what? We have the production numbers, the sales numbers that we got over the weekend from Tesla. That is a catalyst. We also have a negative headwind, which is the fact that the Shanghai factory is not open yet. So we'll see who's going to fold first. Is it going to be the holders? If that is the case, the chart will go down to close the gap at around 995, let's say 1,000. And then we will see how those waiting on the sidelines with the FOMO going to react. Or is it going to be those waiting on the sidelines with the FOMO? Are they going to fold first? What does that mean? It means they've been waiting and waiting and waiting for a few days now since the stock split announcement, and they did not get a pullback. The chart continues to hold at around 1090.5. What if they say, you know what? It's not going to go down. Let's buy right now. If that is the case, the chart will move higher. And all what the chart's doing right now is a bull flag consolidation. The question is, who is going to fold first? The holders or those waiting on the sidelines? In the case of tulips, BTC, Bitcoin, for example, it appears, at least for now, those waiting on the sidelines are the one folding because they're stampeding to buy Bitcoin now. Perhaps they did not get a better price and they bought, at least for now. You cannot read a lot into it because we're not above, let's say, 48,000. But if the buying continues in BTC and those waiting on the sidelines say, we're not going to get a better price than this, and they decide to stampede to buy, we could see Bitcoin moving all the way higher to 53,200. But that depends if we have a follow-up on the buying that we saw over the weekend. What about AMC? This is a 2-hour chart. I'm done with the put options. I closed all of them. It did not go all the way to my target to 21, but it was a profitable trade, no doubt about it. It got us almost 800% gains. That is a lot for one trade. But could we see more losses to come in AMC and perhaps losing 21 as support? Yes, because they're not buying calls. The options volume went down. They're not buying the stock either. We're talking about the apes. So where is the support here? You need a follow-up. You need the apes to buy the stock and stampede and buying call options again. Absent of that, all of this rally will fall apart. But on the positive side, what if this is an ABC pattern? We got the A leg, now we got the B. It got us all the way down, let's say, to 22.5. And then we see the C leg higher to take us perhaps all the way to 36.5. That is a possibility. It will depend on the participation of apes or lack thereof. But for now, once you made a lot of profits on your put options, why take the risk when this scenario is still on the table? Moving on to the conclusion of this video. What do we have on the economic calendar this week? Monday, April 4th, we have factory orders. Tuesday, April 5th, we have the ISM Services Index and the Services PMI. These will be highly important. And then we have the most important day, Wednesday, April 6th, the FOMC minutes. And Thursday, April 7th, we have initial jobless claims and consumer credit. And lastly, on Friday, April 8th, we'll have wholesale inventories. This will be a revision. On top of that, let's take a tour around the globe and play a geography game. We have certain central banks with rate decisions this week. On Tuesday, in orange, we have Australia, that is obvious. And then we have Romania, it appears so. Wednesday, we have Poland. And Thursday, in blue, we have Peru. By the way, there's a problem with Peru. Inflation is surging out of whack with no stop in sight. They say the target is around 2%. They've been tightening and nothing is happening so far. Inflation continues to move higher in the country of Peru. There is another country in South America which I cannot name right now. No cheating, by the way. And then in Europe, we have Slovakia, it appears so, and let's say Hungary. By the way, we forgot another country on Tuesday, just below India, that is Sri Lanka. But here it is on Friday, we have India in light blue. Anyways, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.